Hello, my name's Kurt. I'm a value investor, and that means I like to analyze companies based on their fundamental intrinsic fair value, which looks at their free cash flow projected forward into the future and discounts it properly to today's present value. The value of any investment asset is the current present day value of all the future cash generated by that asset. And so today we're going to be looking at Novo Nordisk, ticker symbol NVO. We're going to look at their financials and a background of the company. And just to let you know, this video came from a comment that one of you left on one of my previous videos. So let's get into the presentation on Novo Nordisk. And just FYI, this includes the Q4 2023 financials for the company. So that's through December of 2023. Novo Nordisk is a pharmaceutical company. It's a huge pharmaceutical company. It's based in Denmark. It's a Danish company. Has major offices all around the world, though, multinational. $417 billion market cap, which makes it one of the largest pharmaceutical companies in the world. It trades through an ADR, which is just a slight note to make sure you're aware of when you're investing in the company, because although ADRs meet all of the accounting and auditing requirements that the SEC requires for U.S. public investment, sometimes the liquidity can be a little bit different, and sometimes just the rules surrounding the ownership and the rules surrounding the shares is a little bit funky, so just keep that in mind. Now, Novo Nordisk has contributed a lot in the spaces that I've listed here. The diabetic medicine is one of their primary functions. They have entered into the chronic weight management medicine, and they also do some medicines related to rare diseases, cardiovascular diseases, and other things. When you get a company this big, they're going to have tons of products, but I'm highlighting these ones because those are what are making a big splash right now. Ozempic and Wegovy are basically two brands of the same medicine, this semaglutide. And again, I'm not a doctor. I have no idea how to pronounce some of these things, so just we're taking in the information and I'm pushing it back out to you. Now, Ozempic and Wegovy are the two major drugs that have been making splashes in the news that Novo Nordisk owns these medicines. They're the ones that develop them, they own the patents, and they're making a lot of money through them right now. They are weight loss and diabetes treatment medicines that seem to exhibit that long-time dream of having a pill or a medicine that you can take that just the taking of the pill helps to reduce obesity and help with weight loss. And honestly, my thought on this, and probably Novo Nordisk's official position, is that there is no magical drug. I mean, when it comes to weight loss, the old adage is you have to consume fewer calories than you exert. And so exercise, healthy eating, those are the number one components to weight loss. However, there are people who struggle even when they have regimens like diets and exercise. There are diabetic issues. There are ways that the body can contribute to weight loss, etc. So these drugs help people. Apparently, they've been tested, they've been approved. And since people are always looking for that simple solution, it's been getting a lot of attention. I have a feeling that over time, people will realize that, hey, this isn't a magical medicine. It helps for certain people, but it's not going to be something that can replace a weight loss regimen, a diet plan, exercise, healthy eating, those kinds of things. However, at the moment, these medicines are getting a lot of attention. But this company has dealt with diabetic medicine for a long time. They have signature products like the Levemir, Flex Touch, and other sorts of injections and diabetic medicine. So I just want to make that clear that what you're going to see in their financials is a representation of the hype that's been happening recently due to these two new drugs that they've released. They have a huge pipeline of other medicines and products that they've had for a long time. And so here is their price history going back to 2005. It shows a very consistent upward trend. And what you can see is in the last year and a half, they've had a huge spike up in their stock price, which has gotten a lot of attention. And I'm calling this question mark, the Ozempic bubble. So is Ozempic something that has just temporarily made their stock price and all their financials go up? We're going to see what their financials look like on their profit side, on their revenue side. But is this price increase sustainable, or is this like a one-time surge because of the excitement and the hype around the product that they have? We don't want to invest based on hype. We want to invest based on numbers, accurate forecasts of the free cash flow that the company will generate. Will they generate extra free cash flow from Ozempic and Wegovy? Yes, they will. But how long term is that bump in free cash flow? Will that fade out? Those are the questions we have to answer. So when you're looking at the price history chart, you can see the trend, but we have to see, is the price justified based on their financials, based on the fundamentals of the company? So let's look at their revenue. You can see the little hockey stick pattern here in the revenue. For a long time, they were growing very steadily, but not as quickly. They were growing slower. And coming out of the pandemic time, they started to grow a little bit faster. And then they developed this drug. They had it approved and generated a lot of news, and a lot of new customers are using their weight loss medicine. And you can see that the revenue has really increased. And this bubble is just showing that time period during the Ozempic release. So over the last 3 years, annual growth was 17% because of this sharp uptick. But if you go back 10 years, the average growth per year is 9%. But you can see a big portion of that is the last year or two. So let's go and see, what does that mean for their profit, their net income? Similar pattern on the chart, similar hockey stick function here. They've made a lot of profits, excess profits, based on the hype and the drug that they've released. 3-year growth, 23%, 5-year growth, 16% per year, 10-year growth, 10% per year. So, okay, well, how sustainable is this? I don't know. But the really sure thing about this company is that way before Ozempic and Wegovy, it was growing very steadily in profits and in revenues. And so we can say this company, if you fade out the noise of, hey, they declined a little bit here, hey, they've exploded a little bit here, if you filter out that noise, you can say, yeah, over the long term, they tend to grow at a very consistent 7-8% per year rate. So where do we add in projecting forward where it's going to be? That's a big question. If we go on to free cash flow, again, I have the trailing 1 year in the black line. In the blue-green line, I have the trailing 2-year annualized free cash flow, and they're very similar. So this is a very steady company. It doesn't go super up and super down a ton. And so this is an interesting thing here. 3% growth is only 19%, 5-year growth 13% per year, and 10-year annualized average is 16%. That's a lot higher than the revenue number. And you can see that the free cash flow growth in the last year or two is not quite as steep. Yeah, we saw it go up quite a bit here, but it's not quite as steep as the revenue and the net income patterns. And so what does that mean? Does that mean that they've been investing a lot into capital? As the cash from operations has been coming in, they've been investing a lot in property, plant, and equipment as well. And we can see that attaining new customers is going to have marketing costs. You can see that on their net income, that the net income's going up. So when you calculate all these things together, you have revenue, you have the cost that it takes to acquire customers, the cost of goods, and then you also have things like capital, plant, equipment that you need to continually reinvest in the company. And free cash flow is what we're showing after all that is taken into account. So yes, they're growing quite well and very consistently, but it's not as pronounced of a steep incline in free cash flow growth since the Ozempic release. However, it is still a very positive trend, 16% per year over the last 10 years, and these numbers are very consistent. So let's take a look here at their shares outstanding. You can see that they have a consistently decreasing shares outstanding trend, which means that the company is constantly buying back shares in the company. This is interesting because it means that if you are a shareholder, your stake in the company continually grows bigger, very slowly, but bigger, and it's a very consistent trend. Over the last 10 years, their annual average decrease in shares outstanding is almost 2% per year. So that's a pretty aggressive buyback strategy. Now, what you don't want is you don't want to own a company who's deploying their free cash flow in buying back shares when their stock price is overvalued. But when the stock price is cheap relative to their fair value, you do want to see the company buying back shares rather than, for instance, paying a dividend, which is less tax efficient, or wasting their money investing into projects or acquisitions that end up wasting money. So, I mean, it's hard to criticize Novo Nordisk for purchasing back shares when they're also investing that free cash flow that they've been making into projects like Ozempic that are making them a ton of money now. And so when we combine their free cash flow and net income and their per share metrics, like the shares outstanding decreasing with the increasing profit and the increasing free cash flow, this is what it looks like. The per share profit and free cash flow trend. You can see Okay, now we're seeing it's very pronounced here in the Ozempic stage. Even the free cash flow looks a little bit steeper now that we've taken in per share metrics into account. And look at the slow, consistent, growing trend. Not a huge disparity between net income and free cash flow. That's always good to see. That means that they don't take huge capital intensive projects where they deploy tons of their profits into a capital project. No, they're very consistent. They spend some of their free cash flow on development, research and development, but for a pharmaceutical company, for me to see that their net income and their free cash flow are so closely connected, I like that. And it's going to come partly from government protections and ways that they can write down their costs so that their free cash flow and their profit are very close together. You can see the percent per year historical annualized free cash flow is 14%. Over the last 10 years. Over the last 5 years, it's 19%. So it's higher when you look at more recent trends because they have this huge increase in the last couple of years. Over the long term, it's more mellow. But here's an interesting thing is, what do the analysts say about the forecast into the future for the company? And when I looked at the consensus estimates, I saw that over the next 2 years, they anticipate 22% growth, 23% growth. But after that, it's going to reduce to 14%, 11%, 8%. So on an average, over the next 5 years, analysts estimate about 14% per year growth, which is in line with their long-term trend in free cash flow per share. So that's going to be really important for us to be educated about what value we should plug in when we're doing our free cash flow, discounted free cash flow analysis for what our assumptions are for growth. Another look at something really important is return on invested capital. We saw that it spiked really high. It's been declining since 2016, but of course with their recent success, it's turned back up a little bit. It's interesting for me to see that they were as low as 20, just over 20%. They've come all the way back around to that. They had a large cycle, looks like here, but in general, we love to see return on invested capital greater than 10%. It means that the company knows how to take their free cash flow, deploy it, and grow faster than 10% in earnings and whatnot. So for them to live between 20% and 40%, and now they're down at the lower stage, but they're going back up. I mean, to me, it's a company that knows what to do with capital deployed. When it comes to really high capital intensive businesses, you're going to see that return on invested capital a lot lower. And for a pharmaceutical company, again, this is really good. Now let's look at their balance sheet. They have $4.7 billion in cash on hand. They have $46 billion about in total assets. And you can see property, plant, and equipment is $13 billion. Intangibles is about $9 billion. So I like to look through some of these things. Their total liabilities is $30 billion. So overall, on net, their book value or equity is about $15 billion. But what we like to do is we like to take an adjustment and take away 30% of inventory, 30% of intangibles. Usually I do 50% of intangibles, but because this company relies a lot on the value of their patents to generate earnings in the future, I'm only going to write them down 30%. We know that patents can also be kind of screwy and run out of time, and so it's important to evaluate them properly. So we like to be conservative, just slash some of their assets down. So we're doing a conservative estimation of their current equity. So instead of $15 billion, I've written it all the way down to about $9 billion when I've taken these adjustments into account, which means their equity per share is only about $2.57. So the current value of the company, yes, it's the future free cash flow aspect, but you have to add in the current equity or booked value. And we have an adjusted book value per share there. So if the company were to never earn any more money from now until infinity, they're still worth $2.57 today just in liquidation value on their balance sheet. Now, they do have a pretty low cash to current liability position. I'd like to see a lot more cash there, but their cash flow is really strong. Their free cash flow is really strong right now. So the money is rolling into the business, so it's enough to pay off their current liabilities. In fact, it's enough to pay off their entire debt, I think, within 3 years. So to me, okay, I'd like to see more cash on their balance sheet, but because of their success recently, I'm okay with them having the amount of debt that they have because it's paid for. And lastly, let's look at their business pillars before we move to the discounted cash flow analysis. The business pillars help us to just understand basically how reliable, sustainable, fundamentally sound is the business. We like to see a lot of green check marks here. they're based off of these general rules. They range all the way from the dividends they paid, the return on invested capital, the shares dilution, the debt and balance sheet, revenue and net income trend, and free cash flow. So in their current valuation and the PE ratio, you can see that Novo Nordisk checks off 7 of the 8 main pillars that I've constructed, and it checks off 16 of the 21 sub-pillars. So I would say this company is fairly fundamentally sound. It's one of the giants. When you have a mega cap company like this, $417 billion, and when the company is consistently growing, a lot of times it's going to check a lot of these fundamental pillars. Now, the company's not perfect, especially when you look at their current valuation, but we like to see a lot of the consistency of revenue, consistency of net income. The shares are being bought back, not being issued, and the debt being checked off in general, free cash flow. So those kind of things, it's good to see a company that checks all of those criteria. So it has a huge moat in the pharma industry. It has had recent success. Now the question is, can it continue to add products to drive that high growth? But as far as fundamentally and going back and looking at the long-term trajectory of the company, I feel very comfortable with making a future projection and that there's not going to be some huge disruption one way or another that's going to totally throw me off. Now, we never have perfect knowledge, but in general, like those fundamental pillars help us to have confidence about that. Here's the valuation that I've done on the company. This is my mid-range scenario, my most basic, straightforward assumptions. I'm going to give them a $10 billion current year free cash flow. I'm going to assume they have a base year free cash flow of $10 billion. I think their rolling 12 months is at $12 billion right now, so this is a conservative start, but I always do that. Even on my mid-range scenarios, I cut back a little bit just in case there's a recession around the corner or something slips and they're just down a little bit. $10 billion base year free cash flow. I'm going to grow the free cash flow over the next 5 years at 14%. That's in line with what the analysts have said, and it's in line with the long-term trajectory of the company, even with their recent success. But I smooth it out, right? Because they had that decline, they had recent success. Overall, I like the 14% number. The analysts agree with that, and so I'm going to stick with it. I'm going to reduce it down to 8% per year over the next 15 years. So I'm going to hope that I can continue to grow and invest into new products, and high single-digit growth for such a big company is something that I think is very reasonable. With a perpetual growth rate of 2%, which means I think in 100 years from now, if there's going to be any companies that are around, this is going to be one of them. And so when a company's that big and it's entrenched into the state of Denmark and all the parts of the economic powerhouse that they are, they're going to be around. They might be growing a lot slower, relative to the whole economy that might be declining, but 2% perpetual growth. A lot of times I assign negative perpetual growth because companies eventually die. But for mega companies like this, my valuation goes out 100 years, and so I think they'll be around at that time. A margin of safety of 25%. Usually I use a 30% reduction for margin of safety, but for a company like this, I'm going to use a slightly safer than typical approach, and it has a large moat, the state investment and protection, where it's one of those like too big to fail type things. So when it gets to big companies and companies that you're more sure about, you can reduce that margin of safety and still feel good. I'm going to use 25%. So with all of these assumptions, the discount rate that balances their current price with all their future free cash flow plus their book value is 9%. So that is my expected annual return from this price level. And you can see here that I've shared the intrinsic value at a margin of safety of 25% for each discount rate. So if you use a 5% discount rate, you're looking at $380, 10% discount rate, $94 a share, 15% discount rate, $46, and a 20% discount rate, only $30 a share. Now the current price is $120 per share. So you can see it's something right below the 10% discount rate range. That's where I get my 9% expected return. But if you're okay with a 7% and 8%, or even lower, if you're okay with those returns over the long term, then you could buy this company. But if you're looking for returns 15%, 20%, this is not a company at the current price with these assumptions that will get you that high rate of return. So when I see 9%, that doesn't typically excite me. I think the company's overpriced right now for a return that I'm comfortable with. A lot of people might be comfortable with a 9% return, but you have to include all of the risks and all of the uncertainty that you're also getting involved with a company like this. I mean, One way we can do that is we can analyze it a different way. We can use our low assumption. So for this, I'm going to set the free cash flow base year to $9 billion, use a 5-year growth rate of only 12%, next 15 years of 6%, and a perpetual growth rate of only 1% per year with a margin of safety of 30%. So I'm going to slash all the estimations by 30%. And that's to replicate some of these uncertainties about the temporary success being sustained and the decently sized debt. And there we get an expected return of 8%. So it didn't decrease by that much given all of the adjustments we made. So the company is fairly robust. And when you tweak with these expected growth rates in the company and their free cash flow, you don't get a huge differential in expected return. So to me, this represents somewhere between a 5 and 10% return at the mid-level estimate and the low estimate. And that's where if you're okay with a 7% return, an 8% return, this company is something that you can feel really good about owning. But if you're looking for something higher than 10%, it would take pretty high assumptions, pretty extreme high assumptions, optimistic assumptions to reach those target returns. So that gets us to our summary of the company. The question is, are you excited over a 9% return on a very safe company? Or are there better opportunities with even more certainty? And we've reviewed some stocks here recently, Google, although it's come under some criticism. But there are other companies that maybe give more certainty with an even higher expected return based on their free cash flow and expected growth. So how predictable is the future of this company? A pharmaceutical company, they rely on continuing to develop products, continuing to get licenses and patents through government entities, and they're subject to all sorts of things like antitrust resistance and regulatory risk. So all sorts of things that could go against their future free cash flow growth. And for a mega cap, it's okay, but we have to be careful whenever we look at pharmaceutical companies or any company that has risks that are like that, or heavy capital intensive risks, anything like that. So I would buy this company if it was under $35 a share. Obviously, it's not anywhere close to that. It's at $120 a share, I think we said. So $35 a share, that's a long way off, but count me in as a buyer if it gets that low ever. And I would sell the company if it was above 75. If you were holding the company right now, I'd be selling it. That's just me. That's for my personal goals and investment goals. So overall, though, for a lower rate of return, I'm going to give this company a 6 out of 10 rating based on my own proprietary rating system, where I combine the value to price ratio with those fundamental pillars. So for a company that has such good fundamentals, it's always going to be a 5 out of 10 or 6 out of 10. But because their valuation is a little bit overvalued for me, it's not going to be in that 8, 9, 10 range, where I've shown some companies recently that are in the 8, 9, 10 range. So go check out my other valuations of those companies if you're interested to learn if you're interested to learn what those other opportunities are. Right now, this company is number 145 out of 311 that I've currently analyzed, and that list is growing, so continue to monitor the channel. Novo Nordisk, I'm sorry, you're about halfway down the pack. I'm not super interested in investing in Novo Nordisk, but it was a really good exercise to analyze it and to show that our assumptions really drive the valuation of the company. If we were to assume 20% growth over the next 5 years, if we were to assume 15% growth for the next 15 years after that, yeah, we might reach a valuation where it's worth it to buy Novo Nordisk. But are those expectations reasonable? And that's the question you have to ask yourself, and do the mathematics behind coming up with an intrinsic fair value. And you just have to be confident in your assumptions. If you're confident in your assumptions, you can evaluate a company how you like. And that's up to you. That's up to your own research. That's up to your own convictions. So this is where I stand on Novo Nordisk. Thank you for the recommendation in the comments, and continue to leave those comments of stocks you'd like to see me evaluate next. I hope you enjoyed going through this with me. Stay tuned. Best of luck investing. I'll see you in the next video.